Have you ever looked at your paycheck, then looked at your tax return, and just scratched your head wondering what percentage you actually pay in taxes? You are not alone. And the truth is, there isn't just one simple answer. So today, we're going to pull back the curtain and demystify the two key numbers that really matter: your average and your marginal tax rates.
Hello everyone, Gemini AI here. This whole breakdown was put together by Samir Al-Rishanani with a little AI support. All right, let's jump right in.
So let's get right to it. What is the real tax rate you're going to pay on that next dollar you earn? I mean, think about it. You get a raise, you score a bonus, maybe you start a little side hustle. How much of that brand new money do you actually get to keep? The answer to that is all about understanding two very different rates.
Okay, first things first, we've got to talk about the foundation of it all. Here in Canada, we don't just have one flat tax rate for everybody. Nope, we use something called a progressive tax system. Think of it kind of like climbing a ladder.
And all progressive really means is that as your income goes up, the tax rate goes up too. But, and you have to hear this part, it's not on all your money. The system is built with these things called tax brackets. As you earn more and step up into a new, higher bracket, it's only the money you earn inside that new bracket that gets hit with a higher tax rate. Seriously, if you remember one thing today, make it that.
Right, so because of this bracket system, we end up with two super important but very different numbers you need to know: your average tax rate and your marginal tax rate. It is so easy to mix these two up, but trust me, they tell two completely different stories about your money.
Let's start with the average tax rate. The best way to think about this one is like looking in your car's rearview mirror. It's all about looking back. You take the total tax you paid for the whole year, divided by your total income, and boom, you get one single blended percentage. It basically answers the question, hey, after everything was said and done, what slice of my pie went to taxes last year?
Okay, but then we have the marginal tax rate. Now, if the average rate is the rearview mirror, the marginal rate is your GPS. It's all about looking forward. This is the tax rate that's going to hit your next dollar of income. So if you're thinking about working some overtime or you're hoping for a raise, this is the number that tells you how much of that extra money is going to taxes. So let's just put it all side by side to make it crystal clear. Your average rate, that's the big picture summary of what's already happened. Your marginal rate, now that is your tool for making decisions about the future. It's the one that helps you figure out, you know what, is it really worth it for me to take on that extra shift? Or if I get this bonus, what's my actual take home? Getting this difference is honestly a total game changer for your financial planning.
Yeah, another way to think about it is right there in the name, marginal. It's the tax you're paying right on the edge, on the very last dollar you just earned, and on the very next one you're about to earn. And that is exactly why it's so important for making choices about your work and your money. All right, that's enough theory. It's one thing to talk about these concepts, but it's another thing entirely to see them in action. So let's make this real. We're going to use a practical example. Let's meet Jimmy and actually crunch some numbers. I promise you, this is where the light bulb really goes on.
Okay, so let's figure out Jimmy's average tax rate first. Let's say after all the math is done, his total taxable income was $20,000, and he paid a total of $3,000 in tax. The calculation here is super straightforward. We just take the total tax he paid and divide it by his total income.
And that gives us 15%. So Jimmy's average tax rate is 15%. When he looks back on his year, he can say, overall, about 15% of my income went to taxes. Simple enough, right? But, and this is the big one, if Jimmy goes out and earns one more dollar, is he going to pay 15 cents of it in tax? No way, not even close. To figure that out, we have to look at his marginal rate. And for that, we need to look at the tax brackets. This is where the story gets really good. So let's imagine a really simple tax system, just so we can see how it works. We'll say there are only two brackets. The first $10,000 you make, that gets taxed at 10%. Anything you earn above that $10,000, up to $20,000, gets taxed at a higher rate. Let's call it 20%.
Okay, so let's apply this to Jimmy's $20,000 income. We don't just tax the whole thing at one rate, we do it in pieces. His first 10 grand is taxed at 10%. That's $1,000 in tax. Then the next 10 grand, the money that takes him from $10,001 all the way to $20,000, falls into that second bracket. That part gets taxed at 20%, which is another $2,000. Add them up, and you get his total tax of $3,000. And because his very last dollar was earned in that 20% bracket, that is his marginal tax rate, 20%.
This right here is the most important takeaway. I'm serious.
Just because Jimmy's income touched that 20% bracket does not mean he pays 20% on his entire $20,000. That is probably the biggest myth in all of taxes. He only pays that higher rate on the money that's actually in that higher bracket. Everything he earned below it is still taxed at that lower 10% rate.
Okay, so our Jimmy example was pretty simple, but the principle is exactly the same in the real world. Here's a look at the actual federal tax brackets in Canada for 2025. You can see it's the same idea, a series of steps. So if you earn, let's say, $60,000, you're in that 20.5% bracket. But again, you're only paying that 20.5% on the few $1,000s you earned above the bracket starting point.
And you can't forget this part. This is just the federal tax. On top of all this, everyone also pays provincial or territorial tax. So your true marginal tax rate is actually the federal rate plus your provincial one, all added together. And that's why the total tax you pay can be so different depending on where in the country you live.
All right, so now you get the mechanics, you understand the difference between average and marginal rates. The big question is, so what? How can you actually use this information? Well, this knowledge is your secret weapon for making smart moves and legally lowering your tax bill. Let's talk strategy. Tax deductions, like putting money into an RRSP, are huge. They lower your taxable income before any tax is calculated. And that's so powerful because every dollar you deduct comes right off the top of your income, meaning it saves you tax at your highest marginal rate. If that rate is 30%, a $100 deduction saves you $30, just like that. Now, tax credits are different. They don't touch your income. They just chop your final tax bill directly, dollar for dollar. A $100 tax credit saves you $100. Both are fantastic, but they work in totally different ways.
So you see, getting this stuff isn't just some boring tax trivia. It's real practical knowledge. It's the difference between just letting taxes happen to you and actually taking control of your financial future. It lets you make smarter choices about everything: your job, your savings, your investments. You now know the rules of the game, so the only question left is, how are you going to play?